Hi, it's Mike Zschunke from Berkshire Hathaway Homes and Shifton Properties in Scottsdale, Arizona. Do you ever wonder who actually sets interest rates? Let's break it down real quick. In the United States, the Federal Reserve, or the Fed, sets a target interest rate called the federal funds rate. This is the rate that banks charge each other to borrow money overnight. The Fed doesn't set a specific rate, but it sets a target range and uses tools to keep the actual rate close to that target range. Decisions are made by the Federal Open Market Committee, or the FOMC, which is currently led by Fed Chair Jerome Powell. They adjust these target rates to manage inflation, jobs, or economic slowdowns. How does the Fed do it? The Fed uses tools like a thermostat to control the money supply. That's called monetary policy. They buy or sell bonds. Buying bonds adds money to the banks and lowers rates. Selling bonds removes money from the banking system and raises rates. They also pay interest on reserves. Banks earn interest for keeping money at the Fed. That sets a minimum rate. They have short-term loans called repos. The Fed lends to banks to keep rates from rising too high. They also borrow, called reverse repos. The Fed borrows to prevent rates from dropping too low. They have a discount window for emergency loans. Banks can borrow from the Fed at a higher rate, sets a maximum rate. The New York Fed handles these daily tweaks to hit that target. Who's on the FOMC? The FOMC has 12 voting members. There's 7 Fed governors, a New York Fed president who always votes, and 4 regional presidents who rotate yearly. They meet 8 times a year to decide if they want to raise, lower, or hold rates. So next time you hear the Fed should change rates, know that it's a complex process. The FOMC uses tools like bonds, loans to balance inflation, jobs, and growth. Thanks for watching. It's Mike Zschunke from Scottsdale, Arizona. Go ahead and hit like and subscribe for more real estate and simple money tips. Thanks for watching. Bye.